Hey guys, hope you're all living through lockdown number 4 and surviving out there. Um, yeah, it's getting thin for everyone, myself included, but yeah, hope you're going well. Without further ado, let's jump into this month's update. So, as per usual, I'll jump through the home loan news, property news, and news on the broader economy. One of the things I really want to get my clients to understand is the times that we're living in are times of great change. So if you can start understanding the dynamics, you can potentially start understanding where the risks lie and try and avoid them. I'm forever trying to communicate to my clients the understanding that there is risk in buying property. It doesn't just keep going up. If you look at Japan still hasn't come back from its 1989 highs. So people think there are no risks. If you think there are no risks, then you are at risk yourself. So let's jump into the news. So the first part is APRA asking banks to cut down on risky lending. So there has been the past couple of months a bit of news in social media and other sorts of influencers basically commenting that certain lenders are allowing borrowers to borrow over 6 times their income. So it's called the debt to income ratio. So if your income's 100 grand, in the past, borrowing 6 times what your earnings are has been seen to be kind of around the top. It's been seen to be kind of high. And the last 3 or 4 years, APRA have actually put in place certain measures where the debt to income ratio shouldn't really go over 6. With that, some lenders actually have been approving loans with a debt to income ratio over 6. So this article is kind of a bit scary to people, but basically APRA have said because house prices are going up so quick, they've asked lenders to kind of review risky lending. So as a result of this, Commonwealth Bank has basically adjusted how they assess loans and made it a little bit difficult to access those higher risk loans. So I've actually had a few people, and there's been a few people on social media thinking, oh no, the rates are going to go up, borrowing's getting hard again. I wouldn't make those assumptions just yet. And my assumptions are actually just saying that lending's going to continue to get easier and rates are going to continue to go down. So I haven't seen any evidence for me to change my opinion on that yet. The next thing I wanted to show you is a basic one, but it's an old one. It's called the fortnightly repayment method. So I'm just going to bring up here a basic loan calculator. Let's put in 500 grand loan, which is about average these days. Sadly, interest rate I'm going to put in 5% because 5% is the average rate that you're going to get over a long period of time. And down here, there's just going to be a few numbers. So I'll explain them. They're very easy to understand. This column here is your normal column for a standard 30-year loan. So your repayments are 2,684 and your interest is 466 grand. So you're paying about double what you've borrowed in interest over the period. All the fortnightly repayment method is taking your monthly repayment, cutting it in half, and paying that every fortnight. So every fortnight is obviously 14 days, but you're paying half a month, which is about 15 and a half days. So you're paying a day and a half extra every repayment. So just by doing that, what you actually do is you pay the loan off 4 years and 9 months earlier, and your interest saving is $85,820, which is a massive amount. So people don't understand how simple these things are and how much you can actually save. Another way I suggest people look at it as well, let me bring my calculator up here. I hope you can see this on the screen, is you're saving 85,820, but you're actually more ahead because you've been making those extra payments that you haven't really noticed because let's face it, 1.5 days extra every fortnight you're not going to notice it come out of your bank account. but I want to do a calculation to show you how far you're actually ahead. So 4 years and 9 months is 57 months, 48, 57 months, correct? And you've actually paid, you're not paying that off 57 months earlier. So let's go 57, 57 times 2684. Let's just round it off to that. And you actually had 153 grand over that period of time. So that's including the extra payments you've made plus the interest. But it really shouldn't matter because that's how far you're ahead. So that's an oldie but a goodie. If anyone needs help on that, get in contact with your bank, get in contact with me. It is very easy to do. Moving on to property market news. Housing commitments are up. Surprise, surprise. Oops. Commitments up. And I've just stolen this, I shouldn't say stolen, used this graph from the ABS proving that. So this pretty little graph here, I think I've actually shown this one before, but the middle one here, owner occupied excluding refinances, so that is people buying houses to live in, has shot up massively. So you can see here, June 2020, it was 13 billion, and March 2021, it's 22 billion. So what's that? That's up about 50% from June 2020, which is really interesting because if you think June 2020, that's in the middle of the pandemic. We really didn't get any dip in there. But yeah, this just goes to show you that it's all fueled by government schemes, first homeowner grants, stamp duty cuts for first homeowners, and other stimulus grants and schemes. But the point I want to make is that more stimulus, and all of these grants and schemes are just stimulus, more stimulus means higher property prices. So just to kind of add to more stimulus means higher property prices. Lockdown number 4 here in Victoria shows the Victorian government anyway, they're going to splash out another 250 million in stimulus, which, you pour money into an economy, stuff's got to go up in value, so you can expect properties to keep rising. On to the broader economy, and this goes on to what I've just been talking about with the additional spending, but it goes in a global scale. So if you broaden your mind a little bit, Biden has now basically come out and said he's going to spend $6 trillion for this year's budget, for 2022's budget, which is basically showing you the extra money that's getting spent. So I always use the example, just so you can understand the level of money printing going on, is that after the GFC, the US government struggled to get through a bailout package through their Congress or Senate or whatever their parliament is. That bill was for $700 billion. So, pretty much 10 years later, maybe a little bit more, Biden comes out with $6 trillion and no one bats an eyelid. So if you want to understand the level of inflation that's happening and the level that asset prices are going to rise further, you kind of need to think in those sorts of levels. That's my opinion anyway. Again, no financial advice. And backing that up on the broader economy, I think a lot of people have actually forgotten the sheer amount of infrastructure spending that Victoria are engaging in. And I say Victoria because all of my clients are in Victoria, but really it's most of Australia, especially the eastern seaboard states. But I just wanted to actually roll down here and show you one of these graphs for record debt. This is actually quite a good article, so if you got time, and you're enthralled by this sort of stuff, go for it. So here we go. So from about 2010 to 2016, the stimulus spending has been around that 5 or 6 billion a year. And lo and behold, the last few years, we've really ramped it up. So 9 billion, 12, 13, and 12 billion again. So we've effectively doubled our infrastructure spending in the last 3 years. And if you actually look at what's projected, now it's 2019, 2020, another 20, call it 20 billion every year. So from literally the last kind of between 2010 to 2017, we're at about 5 or 6, around that, yeah, 5 or 6 mark. And now just a few years later, we're at 20 a year. That's 400%. Again, that's all just printed money. The state government aren't getting this from anywhere. They're borrowing it from us in the future, and the taxpayer has to pay it back. But that actual $20 billion is just created. So they're just creating all this money and dumping it in the system. So if you want to understand why house prices are just going to keep going up, this is the sort of data you need to look to. That's it for me this week, guys. Hope you like the content. Cheers.